All right, welcome back to the deep dive. Today we're diving into a subject near and dear to a lot of our listeners' hearts, and that's technical analysis.
A fascinating area.
It really is. And we're going to make this deep dive super practical, especially for those of you out there prepping for an exam on classical chart patterns and candlestick
And
analysis.
yes, we're going to try to condense things down to the real essentials here.
Exactly. We're going to hit those core concepts and give you the practical stuff that you need to walk into that exam room with confidence.
Absolutely.
So let's get right to it. Think of this as your own personal audio review session. First up, classical chart patterns. Now, one of the real pioneers in this field was Richard W. Schabacker, and he laid out three fundamental questions that any trader should consider before making a move.
Three questions that are really at the heart of trading decisions.
Exactly. First, when did this price move actually begin? Second, what direction is it heading in? And third, and this might be the most important of all, how far can we expect this move to go?
$1 million question, right?
It really is. And that how for question leads us directly to the idea of price targets. Now, it's super important to remember that these targets, as guys like Edwards and McGee and Schabacker himself all emphasize, are not set in stone.
Right, they're not like some sort of magical crystal ball that tells you the
Well,
future.
they're guidelines, frameworks to help us understand the potential extent of a move.
Exactly. They give us a roadmap, but we still need to be prepared for detours along the way.
Absolutely. Now, our source material strongly suggests using a semi-log scale when you're charting these patterns. And this is something that a lot of people, even experienced traders, sometimes overlook. So why is that semi-log scale such a valuable tool for us?
Well, think of it this way. On a standard linear chart, the spacing between price levels is always the same. So a $1 move from $10 to $11 looks the same visually as a $1 move from $100 to $101.
In percentage terms, those moves are vastly different.
Exactly.
Yeah.
And that's where the semi-log scale comes in. It adjusts the spacing between price levels so that equal percentage changes are represented by equal vertical distances on the chart.
So it's kind of like zooming out to get a broader perspective.
Right. And that can be really helpful, especially when you're trying to identify those longer-term trends and see how shorter-term patterns fit into the bigger picture.
Plus, as the source points out, you often can spot potential breakouts or breakdowns earlier on a semi-log scale than you would on a standard linear chart.
Precisely. The semi-log scale can act as a sort of early warning system, alerting you to potential shifts in momentum.
Now, speaking of how far price moves might extend, Edwards and McGee, they made some interesting observations about flags and pennants.
Yeah, they noticed a bit of asymmetry when it came to the price moves following these patterns.
What'd they find?
Basically, after a bullish flag or a bullish pennant, the subsequent price advance often traveled further, in points or dollars, than the move that forms the flagpole.
So the breakout move exceeded the initial upward surge.
Exactly. But on the flip side, after a bearish flag or a bearish pennant, the decline often didn't travel quite as far in points or dollars as the preceding drop that formed the flagpole.
Interesting. So for setting price targets, what's the key takeaway there?
Well, the source suggests that for those downside targets, it's often more effective to think in terms of percentage changes rather than absolute points or dollars. It tends to align better with the actual price behavior.
Okay, now let's get into some specific classical chart patterns. Let's start with the one that almost everyone knows, the head and shoulders top. How do we figure out a potential price target when we spot this pattern forming?
It's all about the vertical depth of the pattern. You measure the percentage decline from the very top of the head down to that neckline.
The neckline being that horizontal support line connecting the two shoulders, right?
Exactly. Then you project that same percentage decline downward from the neckline, and that gives you your price objective.
Okay, and the source actually gives us a couple of real-world examples using the stock of Hailong. There's a smaller head and shoulders top pattern. Walk us through that one first.
Sure. In that smaller pattern, the price drops about 22% from the peak of the head down to the neckline, which is sitting at about $5.40. So to get the target, you subtract 22% of $5.40, which is roughly $1.20 from the neckline at $5.40. That gives you a price objective of $4.20.
And did the price actually hit that target?
It did. The source points out that the target was met in the week right after the price broke below the neckline.
Now, what about that larger head and shoulders top pattern that also formed in Hailong?
In that one, the drop from the head to the neckline was much steeper, about 46%, and the neckline there was at $3.70. So same calculation. You take 46% of $3.70, which is about $1.70, and you subtract that from the neckline. Gives you a target of $2.
And that target was hit as well.
Yes, during the subsequent downtrend. It's pretty amazing how these patterns can play out.
All right, let's flip things around and talk about the Head and Shoulders bottom, which is a bullish reversal. Now, is the way we calculate the price target similar to the Head and Shoulders top?
The idea is the same, but there's a key difference to reflect, that we're now looking at a bullish reversal.
So instead of subtracting, we add.
Exactly. You measure the vertical distance between the neckline and the lowest point of the head. And then you add that same distance to the neckline.
And for these upward targets, we're typically talking about points or dollars, right? Not percentage changes.
Right. That tends to be more conservative and keeps things a bit more grounded.
Okay, the source gives an example using the Saudi Arabia Mining Company. What happened there?
In that head shoulders bottom, the neckline formed around $40.50. And the head went down to a low of about $35.50.
So a $5 difference.
Right. You add that $5 to the neckline at $40.50, and that gives you a price target of $45.50.
And what happened?
The price broke above the neckline in December 2023, and it rallied up to that $45.50 target fairly quickly. Another good illustration of these patterns in action.
All right, let's move on to triangles. First up, the symmetrical triangle. Now, it seems like there are a couple of different ways to go about setting price targets for this pattern.
There are. Edwards and McGee had a more conservative approach compared to what a lot of technical analysts do today.
So how did Edwards and McGee do it?
For an upside breakout, they draw a line from the very top of the first rally, the one that kind of kicked off the triangle formation, down to the bottom boundary of the triangle. Where that line intersects with a vertical line drawn up from the breakout point, that's your price target.
Okay, and what about the more modern method?
Today, most people measure the vertical depth of the triangle, the distance between the upper and lower trend lines at its widest point. Then you add that depth to the breakout level.
So you're essentially projecting that depth upward from the breakout point. All right, the source uses an example of China United Network Communications. With the conservative method, the first rally top was at $6, and the breakout happened at $5.60. So the target was $6, and the source says it was hit. What about the modern method applied to that same example?
In that case, the triangle had a depth of about $1.50, the difference between $5.60 and $4.10. Add that to the $5.60 breakout level, and you get a target of $7.10.
Quite a bit higher.
It is. But the interesting thing is, according to the source, that target was also hit.
Shows you that both methods can be valid.
Absolutely. It often comes down to your individual risk tolerance and trading style.
All right, let's talk about ascending and descending triangles. How do we approach price targets for those?
For an ascending triangle, which often hints at a bullish reversal, you measure the vertical depth at its widest point, just like with the symmetrical triangle. Then you add that distance to the level of the horizontal upper boundary where the price breaks out.
Okay, and the source gives us a pretty long-term example, a 2-year ascending triangle. How did that one play out?
That triangle had a depth of about $7.10, and the breakout happened at $23.90.
So $31 target.
Exactly. And the source says the price reached that level a few months after the breakout. Shows you that these patterns can work even over longer periods.
Now, what about the descending triangle?
For a descending triangle, you're also measuring the vertical depth, but the source emphasizes thinking about it as a percentage change. You calculate the percentage decline from the horizontal lower boundary up to the highest point within the triangle.
Okay.
When the price breaks down below that support level, you subtract that same percentage from the breakdown level to get your price objective.
All right, the source uses Delivery Hero as an example. It shows a descending triangle with a depth of about 31%. The breakdown happened at $100, which led to a price target of $69. Now, the source says the price did reach $69, but then it kept dropping.
Right, which reinforces that idea that price targets are really just guidelines. They give us potential areas to watch, but not absolute guarantees.
Okay, let's move on to rectangle patterns. First, rectangle tops, which can also look like double tops or triple tops. How do we estimate targets with these?
The source makes a really important point about rectangle patterns, whether they're reversals or continuations.
What's that?
The longer and tighter the consolidation, the more likely it is that the eventual breakout will go much further than that initial price target.
Okay, so the length and tightness of the pattern can be a clue about the magnitude of the move.
Exactly.
The source uses Harbor and Bancorp as an example. They had a rectangle top that lasted for 17 months. The initial target was about $11, but what was the longer-term expectation given how long that price had been consolidating?
The depth of that rectangle was about 15%, which is what led to that $11 target after the price broke down below $12.50. But because the pattern lasted for so long and the trading range was so tight, The expectation was that the downtrend could potentially go 2 or even 3 times further than that initial $11 target.
Wow, so the pattern itself was almost signaling that a big move was coming.
In a way, yeah.
Now, what about rectangle continuations? Is the method for figuring out targets similar?
It's basically the same. You're measuring the vertical height of the rectangle and adding that to the breakout point if it's a bullish continuation, or subtracting it if it's bearish.
And that same idea about longer and tighter consolidations leading to bigger moves applies here too, right?
Absolutely.
The source is a great example of this with the Turkey Beast Bank Index. They had a consolidation that lasted for an entire decade before finally breaking out to the upside.
That's a long time to wait for a breakout.
It is. So what was the initial target there, and what were the longer-term implications?
The initial target, based on the height of that rectangle, was 2,760. That's 880 points above the breakout point at 0,880. But because that consolidation had gone on for so long and was relatively tight, the expectation was that the uptrend could really run much further than that initial target.
It's like all that pent-up energy from a decade of sideways movement had to go somewhere. All right, last pattern in our classical chart pattern review. The bull flag. Short-term bullish continuation. How do we estimate the potential upside for this one?
You measure the height of the flagpole, that sharp upward move that happens right before the flag forms. Then you add that flagpole height to the breakout level.
Okay, the source gives us Exalta Coding Systems as an example. They had a bull flag forming after a move up to about $31.11. The flagpole height was about $3.11. So the target was $34.22.
That's right, $3.11 added to $31.11. These short-term patterns can be great for catching quick moves within a bigger trend.
All right, so we've talked about how to estimate price targets for all sorts of classical chart patterns. Now, Richard Schaber, he also said that it's crucial to have a clear signal and to know how to confirm those breakouts and breakdowns. What actually makes a signal valid? When do we know a pattern is really happening?
That's where the art, the craft of technical analysis comes in. It's not always black and white.
So some judgment is involved.
Definitely. But generally, we're looking for a decisive close beyond the pattern's boundary. So above the upper boundary for a bullish breakout, below the lower boundary for a bearish breakdown.
And decisive is the key word there, right? We don't want to get tricked by fake outs.
Exactly. We need to see that price really commit to the move.
But how much of a move do we need to see? What's a decisive margin?
That can be a bit subjective, right? But Edwards and McGee, they tried to make it more objective with their 3% rule.
The 3% rule. Tell us about that.
They said a breakout or a breakdown is only confirmed if the price closes at least 3% beyond the boundary on a daily basis.
Makes sense, gives us a clear benchmark, but the source also says there are some situations where that 3% rule might not be the best.
Yeah, it can have some drawbacks, like with really expensive stocks.
How so?
Well, a 3% move in a stock that's trading at, say, $500 per share, that's a $15 move. You could miss out on a lot of the initial breakout if you wait for that full 3% confirmation.
Makes sense.
And then on the other end of the spectrum, you have those really low-priced stocks, penny stocks, or maybe some futures contracts. A 3% move there can happen in a flash, and it might not even be a real breakout. It could just be some random noise that triggers your entry.
Okay, so if the 3% rule has its limits, what's a better way to confirm these breakouts and breakdowns, something that works for all kinds of different assets?
The source suggests using the average true range, or ATR.
Ah, ATR. A classic volatility measure.
Right. It looks at the average daily price range over a certain period, usually 14 days. Instead of using a fixed percentage like 3%, you use a multiple of the ATR.
So you might say, I'll confirm a breakout if the price moves 1 or 2 times the ATR beyond the boundary.
Exactly. It's a more dynamic approach because it adjusts to the volatility of the specific instrument you're trading. A more volatile stock will need a bigger move for confirmation than a less volatile one.
Okay, let's talk about managing risk when we're trading these patterns. The source brings up this really important concept of the reward-to-risk ratio.
One of the most important concepts in trading, really.
How do we use this ratio to make better decisions?
It boils down to how much potential profit you're aiming for versus how much you're willing to risk on the trade.
So it's all about that balance.
Right. A good reward-to-risk ratio means the potential reward is significantly bigger than the potential loss. Ideally, you want a ratio of at least 1, and most successful traders aim for 2.1 or even higher.
The source uses an example of a head and shoulders bottom to show how the reward-to-risk ratio can change based on your entry and stop-loss placement. In that example, just entering on the daily close breakout led to a pretty bad ratio of 0.84. What made it so bad?
In that case, the stop loss was placed below the low of the pattern right after the breakout was confirmed. The problem was the distance from that entry point to the price target wasn't that much bigger than the distance from the entry point down to the stop loss.
So the potential profit was only slightly bigger than the potential loss? Not a great setup.
Not at all.
But then the source shows how you can improve that ratio by changing your entry and stop loss points. How do they do that?
They got a little more proactive. They entered at that 3% confirmation level above the neckline.
So they got in a bit earlier.
Right. And they also used a tighter stop loss, placing it at the previous day's closing price. By doing that, they significantly increased the potential profit relative to the potential loss.
So they shifted the balance in their favor.
Exactly. And that boosted the reward to risk ratio to 1.5, which is much better.
And then they take it even further by using the ATR, that average true range we talked about earlier, to fine-tune both the entry and the stop-loss placement. And that gets the ratio all the way up to 3.3.
It's amazing what a difference that can make.
So by incorporating volatility into the equation, you can really create some awesome trading opportunities.
You can.
All right, we've talked about identifying those classical patterns, setting price targets, confirming breakouts. Now, the source also talks about two main trading strategies people use with these patterns: breakout trading versus range-bound trading. What's the basic difference?
Well, a lot of those classical chart patterns we've been discussing, they represent periods of consolidation, times when the price is basically moving sideways within a range.
Okay.
During these consolidation phases, you can sometimes use a range-bound trading strategy, which some people call mean reversion trading.
How does that work?
Basically, you're buying near the support level of the range and selling near the resistance level.
You're trying to catch those bounces within the range.
Exactly. But then when the price finally breaks out of that range decisively, that's when you switch gears and start using a breakout strategy.
So you're no longer trying to fade the moves within the range, you're riding the momentum of the breakout. The source uses Citizen Watch Co. to show this transition from range-bound to breakout trading. In the beginning, the price was pretty much range-bound around the 40-week moving average. What candlestick patterns were giving signals for those reversals within the range?
We saw some bearish engulfing patterns forming near the resistance level, suggesting that the price was likely to get pushed back down. And conversely, there were some bullish engulfing patterns appearing near support, indicating potential bounces back up.
So those candlestick patterns were helping traders time their entries and exits within that range.
Exactly.
And then what finally signaled that the range was ending and that it was time to shift to a breakout strategy?
Over time, the price kept testing the upper boundary of that rectangle more and more frequently. And the source interprets that as increasing impatience from buyers. They were ready to push the price higher, and eventually they succeeded, breaking out decisively.
So that breakout from the rectangle signaled a continuation of the uptrend.
Exactly. At that point, you wouldn't want to be selling near resistance anymore. You'd want to be buying the breakout and riding the momentum.
All right, that's a great example of how both classical chart patterns and candlestick analysis can work together to inform your trading strategy. Now, let's move on to our second big area: candlestick patterns in the real world. How do these single pattern candlesticks help us understand the dynamics of the market?
They're like little snapshots of the battle between buyers and sellers. Each candlestick pattern tells a story about who was in control during that specific trading period.
So they give us clues about the balance of power between bulls and bears.
Exactly.
The source focuses on a few key single candle patterns: the hammer, the hanging man, the doji, and the spinning top. Let's start by comparing the hammer and the hanging man. They look identical, but their implications are totally different, right?
They are. They both have a small real body and a long lower shadow, but it's all about the context.
What do you mean?
A hammer forms during a downtrend and is usually a bullish signal. The long lower shadow suggests that even though sellers pushed the price down, buyers were strong enough to bring it back up.
So it's like the buyers hammering the price back up.
Exactly. But the hanging man, it looks the same, but it forms during an uptrend.
And that's a bearish signal.
Right. It means sellers were able to push the price down, even though buyers managed to recover a bit by the close.
So with the hammer, the buyers are in control, but with the hanging man, it's the sellers.
Exactly. The context of the trend makes all the difference.
Now, how does trading volume play into this? Does it make these signals stronger or weaker?
High volume is always a good thing when you're looking at these patterns. If a hammer forms on high volume, it means a lot of buyers stepped in to push the price back up. That makes the bullish signal much stronger. Same with the hanging man. High volume on a hanging man means a lot of sellers were involved, making the bearish signal more convincing.
So volume acts like a confirmation.
Right. If the volume is low, you have to be a bit more cautious. The pattern might not be as reliable.
Okay, next up we have the shooting star. What does that one tell us?
The shooting star is bearish, and it usually forms at the top of an uptrend. It has a small, real body near the bottom and a long upper shadow.
So it's like the price shot up but then got rejected.
Exactly. The buyers tried to push the price higher, but they failed, and the sellers took over.
And what should we look for after a shooting star to confirm that bearish signal?
Ideally, you want to see a bearish candle following the shooting star. That tells you the downward momentum is continuing. And like with the hammer and the hanging man, high volume on the shooting star makes the signal stronger.
The source has a good example of this pattern with Franklin Resources, Inc., BANN, so that's worth checking out.
Absolutely.
All right, next up, the spinning top. What does this pattern usually indicate?
The spinning top is basically a sign of indecision. It has a small, real body in the middle, with upper and lower shadows that are roughly the same length.
So the buyers and sellers were battling it out, but neither side could win.
Exactly. And that usually means a pause in the trend, or maybe even a potential reversal.
And how does volume play into the interpretation of the spinning top?
High volume on a spinning top emphasizes that indecision. It means a lot of traders were involved, but they couldn't agree on our direction. If the volume's low, the pattern might not be as significant.
Okay, last single candle pattern on our list, the doji. What makes this one so special?
The doji is all about indecision. It forms when the open and close prices are practically the same. So it has a very thin real body, or even no real body at all.
So it's like a stalemate between buyers and sellers.
Right, and it's a really important signal, especially at the end of a trend. It suggests that the momentum might be fading, and a reversal could be on the horizon.
The source mentions a few different types of dojis: the standard doji, the dragonfly doji, the gravestone doji, and the long-legged doji. What are the differences between these?
The standard doji is pretty neutral. It just signals that there's indecision, and we need more information to figure out where the price is going next.
Okay.
The dragonfly doji is more bullish. It has a long lower shadow and no upper shadow. When you see that after a downtrend, it suggests that buyers strongly rejected lower prices.
So it's a sign of potential strength.
Right. The gravestone doji is the opposite. It's bearish. It has a long upper shadow and no lower shadow. After an uptrend, that suggests that sellers were able to push the price back down after an attempt to move higher.
Okay.
And then you have the long-legged doji, which has long upper and lower shadows. That indicates a lot of back and forth during the trading
A
session.
lot of volatility, but ultimately no clear winner.
Exactly. And that can happen at tops, bottoms, or even during sideways markets. You really need to look at the context to figure out what it means.
And how does volume play into the interpretation of these different doji types?
High volume always makes the signal stronger. So a dragonfly doji on high volume is a much more convincing bullish signal than one on low volume.
Makes sense. The source gives us some good examples of these patterns, too. They show the standard doji with Indus Towers Ltd, Indus Tower, the dragonfly doji with Accenture Plic, ACN, and the gravestone doji with ICICI Bank Ltd, ICI Bank.
Really good examples to study and see these patterns in action.
All right, let's move on to two candle patterns. What are some of the key reversal patterns that traders look for when analyzing two candlesticks together?
Some of the most important ones are the engulfing patterns, both bullish and bearish, and then the piercing line, which is bullish, and the dark cloud cover, which is bearish.
Okay, let's break down those engulfing patterns first. What do those look like?
A bullish engulfing pattern happens after a downtrend. The first candle is bearish, and then the second candle is bullish and completely engulfs the first candle's real body.
So it's like the bulls are taking charge.
Exactly. A bearish engulfing is the opposite. It happens after an uptrend, with a bullish candle followed by a bearish candle that engulfs it. That shows the bears taking control.
And again, volume is important, right?
Absolutely. You want to see strong volume on that second engulfing candle. That confirms the strength of the reversal.
The source gives us some real-world examples here, too. Caterpillar shows a bullish engulfing, and Bajaj Finance Ltd, Bajaj Finance, shows a bearish engulfing.
Great examples to see how these patterns play out.
All right, what about those Harami patterns? How are those different from engulfing patterns?
With the Harami patterns, the second candle's real body is inside the first candle's real body instead of engulfing it.
Okay.
So a bullish Harami happens in a downtrend. You have a big bearish candle, and then a small bullish candle forms inside it.
And that suggests that the downtrend might be losing steam.
Right. The bearish Harami is the opposite. It happens in an uptrend, with a big bullish candle followed by a small bearish candle inside it.
Signaling a potential slowdown in the uptrend.
Exactly.
The source shows us a general structure for the bullish Harami and a specific example of a bearish Harami with Cadence Design Systems, Inc., CDNS.
Good stuff to study.
Now, what about those piercing line and dark cloud cover patterns?
The piercing line is bullish, and it happens after a downtrend. You have a bearish candle, and then the next candle, a bullish one, opens below the low of the bearish candle, but closes above the midpoint of the bearish candle's body.
So the buyers are pushing the price back up.
Exactly. The dark cloud cover is the bearish counterpart. It happens after an uptrend. Bullish candle followed by a bearish candle that opens above the high of the bullish candle, but closes below its midpoint.
So sellers stepping in and taking control.
Right.
The source gives us a piercing line example with Hart Petroleum Corp., Ltd., BPCL, and a dark cloud cover example with Charles Schwab Corp., SCHW.
Important to see how these patterns look in real charts.
Okay, let's move on to patterns with 3 or more candlesticks. What are some of the key ones we should be watching for?
When you have 3 or more candles, you're getting a more complete picture of the price action.
So the signals are generally more reliable.
They can be. Some important 3-candle reversal patterns are the morning star, which is bullish, and the evening star, which is bearish.
Okay, tell us about those.
The morning star happens after a downtrend. You have a long bearish candle, then a small candle that gaps down, showing indecision, and then a long bullish candle that closes well above the midpoint of that first bearish candle.
So it's like the dawn of a new uptrend.
Exactly. The evening star is the opposite. After an uptrend, you have a long bullish candle, then a small indecision candle that gaps up, and then a long bearish candle that closes way below the midpoint of that first bullish candle.
The dusk of the uptrend.
Right. And just like with the other patterns, high volume on that third candle, the one that confirms the reversal, makes the signal much stronger.
The source gives us a general structure for the morning star and a real-world example of an evening star with Marico Ltd. Marico.
Always good to have visuals to help remember these patterns.
Now, what about continuation patterns with 3 or more candles?
We have the 3 white soldiers, which is bullish, and the 3 black crows, which is bearish.
Okay, let's talk about those.
The 3 white soldiers pattern happens in an uptrend. It's 3 consecutive long bullish candles, each one opening within the body of the previous candle and closing near its high.
It's a real show of strength from the buyer.
The 3 black crows is the bearish counterpart. It happens in a downtrend. 3 long bearish candles, each one opening within the body of the previous candle and closing near its low.
The sellers are in complete control there.
Right.
The source gives us diagrams for both of those patterns. Now, there are also continuation patterns that are a bit more complex, like the rising 3 methods and the falling 3 methods, right?
The rising 3 methods is a bullish continuation pattern. You have a long bullish candle, then 3 small bearish candles that stay within the range of that first bullish candle, and then another long bullish candle that breaks above the high of the first one.
So it's like a temporary pause in the uptrend, but then the buyers regain control.
Exactly. The falling 3 methods is the bearish version.
Okay.
The source gives us a general structure.